Good to see you. It's really, the need to understand what we're really doing. In the class, despite the fact that it's helping us, understand, accounting from another perspective, you know, we have to try as much as possible to, reach people to get to what have um, the knowledge that we're trying to pass. You see, that is why you, as an individual on your part, after learning, you should also try to call people, to check out the classes. And then, like I said, you can always reach me on the numbers displayed to ask questions, okay, at any time, okay. So you should try to share knowledge, let people, get to know what you know. It's good to share knowledge. You see, and I was saying that, despite the fact that you should share the videos, tell people about JairusConsulting.com for the free classes, you should also, endeavor to tell people that you believe have the capacity to sponsor copies, so we can give to students. Not everyone has that capacity, to spend data, to watch or spend money on data to watch classes. So give them the books from their personal library. You can also reach the author, and get clarifications. That's exactly what we are trying to do. Okay, so nothing is stopping us. Nothing is stopping us. Okay, so in this class we're looking at accounting for issue of shares. We've been on this series for a while now. So let's say in the previous classes we've talked about par. That's we're saying, the issue price, okay, per share is the same thing as the nominal price, okay, per share. And then we looked at premium, right? The issued price is greater than the nominal price. Of course, it's per share, right? So what we're saying is that the company is telling you to come and own part of the business, at a value. And we're saying that there's something called registered value, which is more like authorized share price per share, and then we're saying that for you to come and be part of the owner, you must pay the same value as the authorized price, or the nominal price, or the registered price. That's at par. And then if we're saying that you should pay, high or higher than the nominal price, okay, then we're saying that we're issuing it at what? Premium. So we've done this in the last class, the very first class of the series. We did at par, and then the class, that's the second class, we did at premium. So for this class, we're going to be doing accounting for shares issued at discount. So what are we saying? Summary, what we're saying is that your issued price per share in this case is less than the nominal price per share. So what I'm saying is that if, for instance, the nominal price is 1 naira, per share, and then you're now issuing at, let's say, 80 kobo per share. You can see that 80 kobo is less than what? 1 naira. This is the nominal value or the registered value or the authorized value. But you're now issuing at what? 80 kobo, a price less than the what? Nominal value. So when that is done, you have issued at what? Discount. So it's like a normal discount allowed. Discount allowed here. When, you're telling someone to come and pay less. Let's assume you're selling a product and the product is being sold. Let's say the selling price is, let's say, 1,000 naira per unit. And then you're telling the person to come and pay what? Let's say 950 naira per what? Unit. So you have allowed, from the seller's perspective, you have allowed the buyer a discount. So we call it discount allowed. So typically discount allowed is what? A P and L item, right? Or let's simply call what is comprehensive income statement item, right? So it will reduce your income for the what? For the year or for the period that you reported. But in this case, we are issuing a share, and then we are now telling the applicants to pay less than the nominal value. So somehow you're giving the applicants discount. So typically, it is operating, or it's behaving rather as what? As an expense, just like the way your discount allowed is what is operating. But you are not going to report it as an expense, basically, even though at the end of the period, when you're reporting your statement of financial position, or what you also call your balance sheet, the discount on the share issue, which is also called share discount, okay, is usually used to reduce the reserve. So if you have a reserve, the share discount, given on the issue shares will reduce your reserve. But if there's no reserve, okay, the interpretation is that you're going to have to treat it as an asset. Remember, your assets and your liabilities your asset and your expenses behave the same way. Debit behavior. Why this is an item in the comprehensive income statement? This is an item in the statement of financial position, or what you call your balance sheet. Now your share discount, okay, typically reduce your reserve. But where there's no reserve that can swallow it, or that can cover it up, you have to report it. But in reporting it, it will be behaving as an asset. But even though you're reporting as an asset, you will see that there's still no item that can be, or physical item that can be used, okay, as a productive capacity to signify that it is an asset. So it's going to appear or be reported or arranged in the same place where assets are arranged, but it's going to be seen as as a fictitious asset. What am I fictitious? When we say an asset is fictitious, where it is behaving as an asset, but it's not real. Okay, you get so it says it's an unreal asset. Okay, so despite the fact that it's a discount on the share that is behaving as an expense, and because of the fact that as at the reporting period, you're not recognizing, or you're not treating it as an expense in that period, but you're still going to report it in your balance sheet. Okay, and there's no reserve to accommodate it. So it's possible for you to want to report it where the assets are as an asset. But in that case, you must be able to interpret or explain the essence of it appearing there. Okay, where there's no physical asset that can be used to support the figure there. So it's an asset, but it's not real. So at a certain period, depending on the approval of the board of directors or top management, then you can write off the fictitious asset, which is the discount on the shares, or the share discount. Okay, write it off the reserve when there is enough capacity to close that fictitious what asset. So typically what I'm saying here, or in summary, what I'm saying here is that you are issuing a share below the what registered value. And then you must understand that if you have to issue a share below the registered value, then there are procedures, because it's not something that is typically allowed. So where you want to do that, then there must be a general meeting. It must be what? A general meeting, to approve, to what? Approve that what? This share is going to be issued at a discount. And after the general meeting, that discount must be sanctioned by what? A court. Okay? So the court has to sanction that what? Discount. And then usually it's expected that after the sanctioning, you should issue the what share within a month after the what sanctioning by court, or any period as what extended or permitted by the what court that is sanctioning it. So there are various. So okay, without wasting time, I would say you should go and look at CAMA. Okay, CAMA 2004. CAMA here means Companies and Allied Matters Act. Okay, on your own, look at CAMA 2004, section 121, subsection 1, A, B, C, subsection 2, section 3, section 4. So what I'm trying to say is that you should look at all the subsections in what section 121 of the what Company and Allied Matters Act. So that will give you an insight into the procedures required, okay, by law to issue a share at what? Discount. So in summary, what I'm telling you is that share issued at discount implies that the company is issuing at a value less than the nominal value, or the registered value, or the authorized value. Okay, so what I'm saying is that if the authorized value is 1 naira, the company is issuing, let's say, 80 kobo. It's less than that. So that's issuing a share at discount. But I'm telling you that it has to be permitted by law. And what the law is saying is that there must be a general meeting approving it. And then you must also get a sanction from a reputable or from a court, okay, giving you the go-ahead to actually issue such what shares. Okay, and then there's some penalties. So what I'm trying to tell you is that for you to have, on your own, so that we don't begin to discuss this item one other day. So briefly, just go and look at what CAMA 2004, section 121. Okay, and then look at the subsections there and understand the procedures, or as permitted by the what? By law, to issue shares at what? Discount. So if you have questions, you can reach me on the number displayed. I'll be there to reply you with the right answers. And don't forget, you can support us by paying to the account displayed, for online classes, or you can actually pay for copies of my textbook. All right, and then we can distribute to students for free. You can even get one for your own personal library. And then remember, you can get to me at any time, and I'll be there to always give you that explanation that will help your understanding of the subject matter. So let's quickly look at this question here. The following represents the balance sheet of Strongthing Limited. Okay, as table of financial position as at 31st December 2010, we have non-current assets, current asset excluding bank, and then we have total asset there, and then we have liabilities, and then we have short-term reserves. Okay, we have a reserve here, and then authorized share capital 4 million ordinary shares of 1 naira each. Ordinary share is 2 million. Total liabilities there is 5,830. Then we said on the 1st January 2011, 1 million ordinary shares of 1 naira each were issued at 90 kobo per share. You see the issued share there, the issued price there is less than the nominal value there. So all shares are subscribed for, and the payments made in full on application as of 30th March 2011 show necessary entries to record the shares issued. So this is a very strict one. So let's quickly, treat Let's quickly treat right? So what do we have? The strong thing. Okay, so we have strong thing limited, right? So what's the first thing there? I can see that they issued 1 million naira shares of 1 naira each. You are issued at 90 kobo per share. All shares are subscribed for and the payment made in full. So if you have 1 million shares paid for at 90 kobo per share, so that means they're paying to your bank, right? So your bank here will be what? Debit, right? So it's going to be 1 million shares times 90 kobo. So that'll be 900,000, right? Good. So that means they are paying 900,000 instead of 1 million since it's a discount. So we have bank there, so the applicants now. So application money, okay, will be credited with what? 900,000. Okay? Right? So what happened? So these are the applications. Remember, they are what? Each they are applying for what? Shares. So let's give them the shares. So what do you do now? You're going to have to debit, excuse me. So let's say what application will be what? Debited, right? With what? 900,000, right? And what will now happen? You're crediting what? Excuse me. You're crediting what? Ordinary share, right? With 900,000. But remember, your ordinary share cannot change because it has been registered. If it is 1 naira, it must be 1 naira. Okay, so if there's an excess premium, there's what? A decrease, discount. Okay, so it means that the ordinary share has to remain what? 1 million. So when you remain 1 million, must increase it by what? 100,000, right? So we're going to have to now debit discount, share discount. Do you understand? That will take the decrease. Excess share premium takes excesses. Decrease share discount takes decreases. Do you understand? So what I'm saying is that ordinary shares supposed to be 1 naira, but we said 90 kobo. So there's a discount of 10 kobo, which is now a decrease. But your nominal value cannot change. So that decrease is taken to what we call the discount account or share discount account. Do you get what I'm saying now? So now ordinary share credited 900,000 because that is what the applicants paid for. But remember, we gave them discounts. So that means the ordinary share has to remain 1 million. So it means you're going to have ordinary share taking back its what? 100,000. But we now have to debit what we call share discount to be debited with what? 100,000. So what it means is that the ordinary share will return back to 1 million. Then that discount will now go to the share discount account. Okay, so the share discount now is the fictitious asset we're talking about, where there is no reserve to accommodate it. Okay, some approach tell you to report as a negative reserve. Okay, which means that it is, but can you really keep what you don't have? Okay, or can you actually spend what does not exist? You see, that's why sometimes it is advisable to let it appear as an unreal asset that cannot be written off when there's enough reserve, instead of just going there and then giving a negative reserve. But notwithstanding the approach you want to use, but you will be able to give notes and disclose your explanations to back up the interpretation of your report, so that users will have an understanding of what you're trying to say. So basically, we have the money paid to the bank by the applicants, so give them the shares, and then we give them the discount. So here now, what do we have? So this is our bank. So is there an opening value for the bank? Is there an opening value for the bank? Bank is opening value here, which is balance brought forward there, is 800,000. And then we got 900,000 from applicants. So we have applicants paying what? 900,000. So the money in our bank will increase to 1,700,000. So there's a new balance for bank, 1,700,000. Okay, there's a new balance. We have balance brought down, 1,700,000. That's for bank. So applicants now. So we have what we call share applicants or application account, right? So debited bank will credit them. So we credit, we say bank, right? How much? 900,000. So this goes to where? Ordinary share, 900 times. Okay. So we have the application account there. Then the next one will be what? The ordinary share capital account, right? So we have ordinary share capital account. Okay. So what do we have? What do we have there? So we have the application here to be what? 900. Now remember, ordinary share will not change. The nominal value will not change. So there's a discount. So we have share discount of how much? 100,000. So that means, okay, it should be 1 million. But remember, there's an opening balance. Okay, there's an opening balance. So how do we do it? Let's put opening balance here, or let's just do it the right way. Excuse me. So we have balance brought forward. What's the opening balance for share capital? 2 million. So we have 2 million. Okay, so here we have the application, which is the application there, 900,000. Then we have the what? Share discount. Okay, share discount here. So we have the share discount of how much? 100,000. So that everything becomes what? 3 million. So there's a new value for ordinary share. So we have balance carried down to the what? 3 million. So we have balance brought down to the 3 million. So we now have our what? Share discount. This level, double should not be a problem. Otherwise, you go back and we'll take that class. Okay, so share discount now. We have ordinary share capital, right? Which is 100,000. So there's a value here for share discount. Okay, now remember, your share discount is carrying a value because, you know, we want to report it different from what now? The reserve. But ordinarily, I could have decided to just write it off straight to the what? Reserve. But we want to do that in a form of notes so that users will understand where we're coming from. Okay? So if I can start to write it off directly, instead of me doing balance card, I'll just credit reserve here and take it straight to reserve, raise the journal, and clear it off. But because for some reason you want to give a good impression or a good explanation or a good understanding of your report, you want to let them know that there is a discount has been allowed on the share that has been issued. Okay, so let's show the statement of financial position. So we have statement of financial position. Okay, as at what I think it's 30th March 2011. Okay, so we have the assets. What are the assets here? Non-current assets. According to the question, non-current assets here 4,250,000. So we have 4,250,000, right? And then we have current asset excluding bank. Okay, current assets excluding bank. So what's the current asset now? 780,000 excluding bank, right? 780,000. So we now have bank. Bank has a new value. 1,700,000. So what do we have? What do we have? We have 4,250,000 plus 780,000 plus 1,700,000. So what I have 6,730,000. 6,730,000. Okay. So this is your total assets, right? So let's go now. We have liabilities. So what do we have there? Short-term liabilities. Short-term liabilities here we have 1,250,000. And we now have reserve. Okay, so I just call that a note. That's the first note of the. Let's call it note 1. So what's note 1 here? So we have reserve brought forward. What's the reserve brought forward there? 2,580,000. 2,580,000. There's a share discount. So we have enough reserve to what? To accommodate it. So we have our discount on shares. Okay, how much is that? 100,000. So if that comes in, we have 0, 0, 0, 0, 8, 5 minus 1, that's 4. So we have 2,480,000. So we have 2,480,000. So when you add this up, what do you have? 1,250,000 plus 2,480,000. So what do I have? I have 3,730,000. 3,730,000. So what's now our what? Ordinary share capital. The new one is what? 3 million. So we have 3 million. So what do you have? 6,730,000. This is your total liabilities. So you can see total liability is 6,730,000. Same as the total asset of 6 million. Total asset is 6,730,000. Total liability is also 6,730,000. You can see. So what we're saying is that we've issued the shares, but was issued at discount. Okay, we got the money, but also accounted for the discount that was given to the applicant. So that reduced the discount reduced the reserve from 2,580,000 to 2,480,000. Okay, so we had like a 10 kobo discount per share. We issued 1 million shares. So one value or one unit of the shares, 1 naira, issued at 90 kobo. So instead of bringing in 1 million naira, I brought in 900,000. So that discount is accounted for, and then the effect is on the reserve because there is enough reserve to accommodate it. Okay, so this is basically issuing shares at discount. If you have questions, you can reach me on the numbers displayed up there to reply you with the right answer. So don't forget, you can support us by paying to the account numbers displayed, or you pay for copies, okay, of my textbook, a sponsorship that we can give to students for free. Thank you.